Good afternoon. This is Jim Deitch, Teraverde, with Karthik Kumar from Tata Consultancy. Karthik has had a tremendous career, both internationally and domestically in the residential lending space, been able to work in a variety of countries, Australia, Eastern Europe, Western Europe, and the United States. And he's here today to talk about some of the changes that are arising and whether or not you're going to digitally adopt by choice or by not. So Karthik, with that introduction, why don't you just kind of speculate about what you see in the environment near the end of 2020 and what's 21, 22 look like? And you pick the area you want to talk about as long as it's related to resi lending.
Absolutely. Thanks a lot, Jim. I would say, a pandemic ending, I don't think so there's going to be one exact date. So it has a severe impact on when people call social distancing to end, when leadership is ready to allow their employees to be exposed to borrowers, when borrowers are ready to no longer just talk over the phone or use a mobility app, because there's a school of thought which says that don't shut your branches. It's too early to do that because the social vacuum that is getting created will very, very soon come back. Like every other industry, like people thought movie theaters would go away once, the videos and Netflix and everything came. But, you look at the numbers Avengers makes, Black Panther made. So there are some things fundamentally people are used to. If people love walking into a branch, looking into someone's eyes, understanding their loan, that would still be there. So I wouldn't say that this industry's digitization does mean that there's no longer a face-to-face. I think that what percentage is a separate thing. Second thing, what does digitization in mortgages mean, Jim? I think today, if we were to walk across 6 banks, one being banking, one being non-banking, one regional, one credit union, or a broker, you would see 6 separate definitions of digital mortgages. Can I get one understanding? You would pick some of the largest players in the market who think that putting a mobility solution means digital. I don't think so. That's true. We can talk about companies in Korea, called Hana. I was reading online that from application to funding, it takes them 36 hours. When would we ever get there? Isn't that a question? If today a millennial wants a credit card, it's 60 seconds. They need a car with a car loan. They walk into a dealer, they get it in 60 minutes. But they want a home loan. They've identified the property. They have the down payment. They have everything ready. But now 60 days more. So, when is that industry going to be there? And can there be uniformity of digital experience? Why is it that when I use a credit card, it doesn't matter to me whether I'm using the credit card of JP Morgan Chase or Citi or PNC Bank, just doesn't matter because I know what the card's utility is. When is lending going to be a common industry thing? There will be definitely experiences, differentiations. But at the end of all of this, Jim, I feel standardization of at least define what digital mortgages mean is very important for this industry. And, it's still not going to take away branch banking or in-person or brick or mortar totally out of the equation.
Some of the, you've raised some really interesting comments, and particularly in the United States, that 60 days could even be longer in this environment.
Yeah.
One of the elements that I saw from the MBA cost study just released is the price of doing, the cost of doing a loan continues to escalate.
Yes.
And there are high sales components to it, but there's also a pretty big element of operational and supervision components.
Yeah.
And one of my colleagues, Jonathan Core from Ellie Mae, once commented that it probably costs more to manufacture a stack of paper to do a loan file than it costs to build a car. So I did the research, and frankly, that's true. The cost that GM has to build a Buick Enclave SUV is about $2,300, and the operational cost for stacking a piece of paper for a loan file is $2,600 of direct touch labor. And that's just crazy. So how do we fix that? How do we get that uniformity or the ubiquity of the experience? How do we deal with some of the secondary market requirements that have been slow to change? How do you compress from that 60 days to 60 minutes to get an answer for a consumer?
Sure. I just want to give you a heads up, Jim. My answer is going to be a very long one. You got me started on one of my favorite topics to talk about. So first of all, I think one thing with this industry, outside of technology, outside of whatever imaging system used, the denominator, if I had to mathematically define, your efficiency is defined by the first step you take of the kind of paper you want to deal with. Because you have scanned paper does not mean you turn digital. Today, you have the ability to get a 1003 digitally, which means that your borrower is filling in information. You can take that information and keep it as a metadata. You can keep it separately as data that you can put rules, algorithms upon. Are you doing that? Probably, probably not. But what are you definitely doing? You are converting it into a PDF or a JPEG and putting it in your imaging repository. 24 hours later, your processor starts, and they will start with it as if they're using a physical piece of paper. There is no digitization in that very step, because if they have to refer to the borrower's name, they will type it up as much as possible or correct it from some data that is coming. You are today not letting digital data that you're sourcing to sustain its digital substance or material to the end of it. You are converting it into paper format, or what I would call as JPEG and PNG formats, and slowing down your processor's work, your underwriter's work, and your closer's work. Imagine we had a system. Again, I'm talking future vision, that there's a system which does not have any LOS, no monolithic core system. Imagine I have a system that allows me to take borrower data, all the information I get from third parties. Today, I have technology. I have beautiful products in the ecosystem that can be leveraged, where I get digital income, digital assets, digital collateral information, whatever you want, you can get it digitally. Take the data, keep it digital, run every rule based out of it. The moment you stop that and you move everything to paper, you have just added 25 to 30 days to your process. You cannot, after the pandemic, you can no longer say that the title and appraisal are taking me 15 days each. What if you had an appraisal waiver, right? What if the title comes to you in 1 or 2 days? What if the title industry embraces blockchain? You'll be getting the reports in 20 minutes time. Then are you telling me that the 40 days, 50 days will now become 2 days? I'm not sure about it. So I think one of the biggest problems for this industry is to accept the fact that you are not leveraging digital data the way it was meant to be. You are actually converting everything into manual effort. I would say that's my view.
And that's an excellent view. One of the industry leaders that I spent a lot of time with is Brent Chandler from FormFree.
I know.
And the when Brent and I get together and just talk about the future, his story is that the reason he named FormFree is that you really have to go to direct source data from an independent third party, because then you get it a couple things. You get the digital data as opposed to documents. You get the authenticity because it's sourced from outside the borrower.
Yes.
And you get the ability then to act upon the data, to validate it, to parse it, to combine it, to do all kinds of operations. And essentially, you're emulating in a larger scale what some of the engines that do credit cards or consumer lending or auto lending that you previously referred to. Because there's nothing magic about underwriting a loan that is secured by residential real estate. It's self-imposed issues, some which will be attributable to secondary marketing agencies. But even there, you're making progress because you can get a collateral assessment or collateral risk evaluation and say, maybe we don't need an appraisal, maybe we just need something else. And all of that will take cost and time out of this. So what's the impediment? Why can't we just, flip the switch? Form Free can already provide assets, income, credit in digital form. What's holding back adoption?
If that's a question for me, Jim, I would say holding back on adoption is you can never fix a flight when it's in motion. You can't repair its engine when it's in air. You have to land it to repair it. And that's exactly what's happening, is that there is never an ideal situation that you could just stop producing loans and revisit your entire, because this is a business model change. You can change your operations. If you're telling me the underwriter is the highest skill and the most scarce skill today, have you ever thought of the tasks that your underwriter is doing? For the last 10 years, each time a change happens, it could ideally be given or de-skilled to another resource within your organization. But because there is ambiguity with how to adopt a change, you give it to your best resource. So you added 3 minutes to an underwriter, and those 3 minutes have cumulatively added to another 60 minutes of their workload. If you were to logically split that, the underwriter could be freed away of many calculations, many clerical, many administrative tasks that they're today bound to do to bring up their decision making and rationale. Operations can still change. Technology can change. People have found very good Scrum methodologies to run parallel and then move switch. Microservices is globally being adopted, Jim, and microservices is not too far away. A lot of good modules. It's the Lego block culture, right? You have 1, 2, 3, 4, 5 Lego blocks. Today, what is happening? These Lego blocks are being put on top of a monolithic. I wouldn't say it's an inefficient system. You have a system that's monolithic. It takes time to change. You're putting your microservices on top of it, and then you're blaming that I'm not getting the results. You have to retire the system below you. And the third thing, if one had to make that change, it is a business model change. It is a culture change, and very deeply and very heavily, all parts of the organization to subscribe and buy the change. Because if you have one part of the organization, be it risk, control, technology, product, that isn't convinced, it is going to be very difficult to roll out or accept the fact. And for example, I feel Form Free is our Uber or our Amazon or our and Brent is probably our Elon Musk. He is actually making that extremely good change to this industry, and it's only for the sensible to embrace that and capitalize on that.
I had a chance to speak with Clayton Christensen from Harvard about 2 years ago, prior to him becoming ill. And we talked about disruption and how one of his theories was the incumbents have such a hard time to disrupt anything or change anything because they have the aircraft in flight. And that the most successful disruption is either done by small units within that or completely separate from the core operation, or startups. We had a short discussion about the spectacular lack of success, save one or two, of so many of the firms that have come from the fintech side trying to get into the mortgage business, and they just have not been able to get traction, and in some cases even survive. Why is that?
So, Jim, be it refinance or purchase, I would say one of the heavy things when it comes to home buying is that you're buying your dream for the next 30 years. And if this was buying a movie ticket or just driving up to a Costco, Sam's Club, buying the latest technology, headphones, and having my ability to return it, I would do it. But when it comes to buying a home and buying a loan, because for the next 30 years of your life, every month that one debit's going to happen. It is going to constitute a key percentage of your household spend. There is a lot of emotional decision that is attached to it. I'm not saying that startups or fintechs will have difficulty in reaching out to borrowers, but they will not be able to create overnight trust. They can create overnight brand. They can create a lot of this thing. They can place ads between Sunday games and make it interesting, get the word out. But you will never be able to build a brand that today the bank that you've been putting your savings for the last 20 years, or you've seen your parents walk up to and put that trust cannot be replaced. I think besides, and the millennials are going to be an anomaly to this rule, let me tell you. They will feel a lot more excited picking up their MacBook at 11:30 in the night and start shopping for a loan. Probably we aren't used to that kind of an industry. I'm not saying that startups or fintechs won't succeed, but their success has its own gestation period. We've had great successes with Quicken Loans, Loan Depot. They've kind of rocking the charts with numbers because they patiently created their brand. Many fintechs do not come with that kind of patience. They come with their fundings that think that overnight they're going to be successful, or they overestimate the gestation of break even. There's a good wait time. So for a fintech that does not have too much of patience invested, I'm not even getting to money, mortgage lending is not the place for you. If you think you're going to stay here long, you are going to get returns.
That's a very interesting comment. I spent a fair amount of time with Bill Emerson from Quicken, and one of Bill's insights that he repeated, to the industry as a whole and in smaller groups in particular, was Quicken is not a fintech company.
Yes.
Quicken is a consumer products company. And the only thing we do differently than the traditional face-to-face loan officer in building relationships with customers and in nurturing those relationships and exploiting those relationships in a positive way is we never meet our customers face-to-face. Aside from that, everything we do, it's leveraged by the digital element. It's leveraged by the fact that we can spread the relationship building activities through distance and time via electronics. But make no mistake, this is really about relationship building. And if you don't get that, you don't get mortgages, because as you point out, it is a very emotional decision to buy a home, particularly your first home. And that is one of, I think, the challenges that Quicken has is to get the purchase side of the business. They are flawless in executing the refi business. Through the HMDA data, you can see they make some inroads on the purchase side. And it's kind of interesting to see where they've had that success geographically.
Yeah.
So when I hear you, I'm going to restate what you told me in a slightly different way. And it's one of my theses, is that to be successful in this business, you need domain knowledge and technical knowledge, and they have to be equally applied to weave that domain knowledge into any technical system you have, because this industry is so heavily regulated. It's got so many different twists and turns that if you can't take domain knowledge and technical knowledge and weave it, you are destined to either fail as a fintech or fail as a lender, because you'll never get your costs down. Could you just respond? Yes, no, some insight?
Absolutely, yes. That's how I read it, Jim. You can have a great operations flow, great way of understanding the domain, understanding the regulations, but without good technology, you might not be successful. You might be a fintech that has got a mind-blowing idea. It's so different, it's unconventional, but if you disregard even 10% of what it is required operationally, or miss an important regulation or a licensing aspect, you are still going to be incomplete. So both of these things go hand in glove. You can't compromise. I totally agree to that aspect, that both these things are equal, and to one, to be a successful lender, at least in the post-COVID world, you cannot, have one in hindsight as against the other. And I do agree to your comment about Quicken. It's not a fintech, but at one point of time, they never had brick and mortar, and everyone in the industry thought that they're going to, have a massive disaster and probably at least a failure to launch. Look at it today. Look at their. I'm a proud shareholder of Quicken. Irrespective of what it is, I know what that brand carries. I know how solid it's going to get returns.
Awesome. Intercontinental Exchange and their purchase of Ellie Mae, and particularly the valuation and what it almost has to be a strategic buy based upon the valuation. What do you see that ICE will bring to the mortgage banking side, kind of at the very front, and then how far back do they take it into building essentially a loan exchange that looks like some of the other bourses that they have supported?
I'll make this answer probably my shortest one. I might not want to respond to that.
Okay.
At least on the ICE aspect, we work with them.
Fair enough.
Yeah.
Okay. Let me change that question to what do you think is going to happen with the GSEs and Ginnie Mae in terms of market share? Will there be a reemergence of either private label securities or whole loan lending or other sources that would go outside the GSEs in the 5-10 years hence?
I know, keeping aside the aspect of any political commentary on the GSEs, I do feel that they are the integral backbone of this lending industry. For the same dollar, for you to come back without the GSEs, you can't even imagine. Private investors, at some point of time, there'll be some aspect, some percentage of loan that will be there. If you look at it, the conventional loan limit has been revised. Hypothetically, just think that if they had kept it static at 2015 level, probably 70% of loans today would categorize into jumbo, for that matter, and the private market would go. GSEs are very proactive. I would give them that credit. They are extremely proactive. They are accepting technology, if not enforcing it. They are accepting technology. They are modernizing their platform, their communication. That's what the lender needs. Pricing is something that's a very competitive force, and I think at all points of time that competition will always remain. It's a Coke versus Pepsi kind of a question. That competitiveness is healthy. The industry is enjoying that. That will remain, but that's not going to change the presence or dominance of any segment. I feel this place in the next 5 years would have not seen too many players when it comes to GSEs or any such thing, but it would be digitized to an extent that we can go back and say, hey, you remember December 2020 when we spoke, the GSEs were working like this. I would say that blockchain is going to happen. MSR trades are going to be on click of buttons. There's no longer tapes. There's no longer any data transmission issue or any such thing. It's going to be blockchain with audit trail. Sooner or later, someone is going to come, and it would be very, very exciting to see.
Well, Karthik, I really appreciate you taking the time out of your
Sure.
very busy schedule and sharing the insights, and really appreciate the knowledge that you shared with our readers today. So thank you so much. Really enjoyed it, and take care.